You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
So, in early 2026, gold officially crossed the $5,000 an ounce mark. And, I mean, it is just a massive psychological milestone.
Oh, absolutely. It's huge.
Yeah, and the financial headlines are just absolutely running with it. But there's this terrifying reality that those headlines really aren't telling you.
Right, the hidden mechanics of it all.
Exactly. A massive percentage of investors who are jumping into the gold market today, driven entirely by this fear of missing out on that $5,000 print, they are mathematically guaranteed to lose money before they even finish their very first transaction.
Yeah, it is. It's the classic trap of market euphoria, really. I mean, we see an asset hit a historic high, and suddenly retail capital just floods the zone.
Just blind panic buying.
Precisely, and they do it without any structural understanding of what the asset actually is, you know, or how it's priced, or, and this is the big one, what it actually costs to simply hold it.
Yeah, I completely agree. Because, I mean, picture this. You look at your phone on a Saturday morning, right? You're sitting on the couch checking your portfolio, and you see all the inflation fears, the recession talk, the wild equity swings.
It's a lot of noise.
It is. And then right there in the middle of it, you see gold shining at $5,000.
Mm-hmm.
The instinct is to just, buy it to make the anxiety stop.
Just hit the buy button and feel safe.
Right. So for today's deep dive, we are stripping away all that doom and gloom prepper mentality. We are going to look at the actual mechanics of gold. And to do that, we have a really robust stack of materials today.
Yes, a very solid foundation for this discussion.
We've got recent institutional guidance from Chase, a highly pragmatic analysis from Money Magazine, specifically a piece by Mark Guberti from May of 2026, and a really comprehensive beginner's guide from ATI.
And what is really fascinating about this specific stack of research is the consensus.
Oh, yeah.
Yeah, I mean, whether you are looking at Chase's institutional modeling or ATI's retail guidance, the fundamental utility of gold in a modern portfolio remains remarkably consistent.
They all basically agree.
They do. It is not an engine for generating outsized wealth. It is, well, it's a highly specific risk mitigation tool.
Okay, let's unpack this because that is the core mindset shift we have to make right now.
Yeah.
If you are listening to this, hoping to find out how to, turn $10,000 into $1 million by writing gold to $10,000 an ounce, this isn't for you.
No, definitely not the place for that.
Right. But if your goal is to figure out how to integrate this asset to actually stabilize your portfolio, without overcomplicating your life or falling into those hidden traps that just bleed your principal dry, then you are in the right place.
Yeah, we have to start by aggressively defining what gold isn't right before we even try to define what it is.
Makes sense.
Because that $5,000 headline, it creates this illusion of exponential growth. It's similar to how people view early-stage tech equities.
Oh, like they expect it to just go parabolic.
Exactly. But gold is a totally different beast. If you approach it with an equity mindset, expecting it to compound and produce overnight riches, you will misallocate your capital. You'll mismanage your risk.
And then you just get crushed when things normalize.
Right. You ultimately lock in significant losses when the cycle inevitably turns.
So, okay, if it's not a growth engine, let's talk about why it even belongs in a portfolio in the first place. I mean, we're living in an era of hyper-efficient digital markets, algorithmic trading, complex derivatives, all this high-tech stuff.
Very complex systems, yeah.
Why are institutions and individual investors still dragging this heavy, inert yellow metal into the mix?
It's a great question.
The Chase and Money articles, they immediately point to its historical classification as a safe haven and an inflation hedge. But let's get into the actual mechanics of that. It really just comes down to correlation, right?
Yes, specifically its lack of correlation to traditional financial assets.
Okay, break that down for us.
Well, to understand why, you have to look at what drives the price of a stock or a bond. I mean, an equity is just a claim on the future cash flows of a corporation, right?
Yeah.
And a bond is a contractual obligation for debt repayment. Both of these are inextricably linked to the broader financial system. They depend on corporate earnings cycles, central bank interest rate policies, and fiat currency stability.
They were tied to the system itself.
Exactly. But gold operates completely outside of that framework. It is a tangible commodity, and historically, it's a stateless monetary asset.
So because it exists outside the balance sheet of any government or corporation, it isn't subject to the exact same gravitational pulls.
That is the perfect way to phrase it.
Like when the S&P 500 takes a sudden 15% haircut because a central bank unexpectedly hiked rates, gold doesn't automatically follow suit.
No, because it doesn't have an earnings multiple that needs to be compressed.
Precisely.
And in moments of acute systemic stress, when market participants begin to actually question the stability of the currency itself or the solvency of the banking sector, capital flees those financial assets.
Runs away from the system.
Right. It seeks refuge in an asset with zero counterparty risk. That flight to safety is what creates that negative correlation during market panics.
So when the stock market is crashing, people literally panic buy gold.
Yes. When equities plunge, gold often holds its ground. Or it actively appreciates because institutional hedging algorithms and retail panic buying drive up the spot price.
I look at it like the ballast on a ship.
Oh, I like that analogy.
Yeah, think about it. When you build a modern portfolio, you are basically building a vessel. You have the engine, that's your equities, your growth assets, the things actually propelling you forward and building long-term wealth.
The things doing the heavy lifting.
Exactly. But a ship with a massive engine and no weight at the bottom, it is going to capsize the exact moment it hits a rogue wave.
It's too top-heavy.
Right. You need ballast. You need a heavy, boring, inert weight sitting at the very bottom of the hull. Now, it doesn't make the ship go faster. In fact, on a calm, sunny day, it actually slows you down a bit.
It creates drag, yeah.
But when the storm hits, that ballast is the only thing keeping the vessel upright. But if it's just a ballast, why do people get so obsessive about it?
Well, this is where the reality check comes in. Because your ballast analogy perfectly highlights the primary limitation of gold. It is literally dead weight.
Right.
The Money and Chase analyses are adamant about this, and it is honestly the single most misunderstood aspect of precious metals investing. Gold produces absolutely zero yield.
Zero. No dividends, no interest, no stock buybacks. It's just a rock.
It is a rock.
It doesn't innovate, it doesn't acquire competitors, and it definitely doesn't breed to make smaller gold rocks.
Exactly. It just sits in a vault. I mean, think about it. When you own shares in a multinational corporation, that company is actively utilizing your capital to generate free cash flow, and a portion of that is returned to you.
Right, through dividends or share appreciation based on real earnings.
Right. And when you hold government debt, you are being compensated for the time value of your money. But with gold, there is zero internal compounding.
None at all.
The only mechanism for realizing a profit is price appreciation, meaning you are entirely dependent on a future buyer being willing to pay a higher fiat currency price for the exact same asset than you paid today.
Just the greater fool theory, basically. Or, well, relying on supply and demand shifts, which introduces a huge opportunity cost.
The massive opportunity cost.
I mean, if you have $100,000 tied up in gold for a decade and it just trades flat, you haven't just made zero.
No, you've lost ground.
You've actively lost all those compounding returns that money could have generated in, say, a baseline index fund over those 10 years.
And that is exactly why gold can experience these grueling multi-year drawdowns or just periods of absolute stagnation.
The lost decades.
Yeah. There are market regimes characterized by strong economic growth, stable inflation, and robust corporate earnings. In those times, capital naturally flows away from zero-yield safe havens and pours into productive assets.
Makes total sense.
So if you buy into gold at a peak, expecting it to behave like a momentum stock, the lack of yield combined with sideways price action will simply grind you down psychologically.
Which brings us to a highly pragmatic point from Mark Guberti's piece in Money Magazine. They actually provide a specific checklist for who should actively avoid gold.
Yes, I found that really refreshing.
It is, because usually financial media just pushes everyone to buy everything all the time. But they explicitly state that there are specific listener profiles who should skip this deep dive entirely and focus on their foundation.
It is a critical triage step. I mean, if your investment time horizon is short, meaning you need to deploy this capital within the next 1 to 3 years for, say, a down payment on a house, or tuition gold is far too volatile.
You don't want your tuition money dropping 20% in 6 months.
Exactly. Furthermore, if you are operating with a small initial nest egg, your primary objective must be compounding growth, not wealth preservation.
Right, because you cannot preserve what you have not yet built.
You don't need a massive lead ballast if you're just learning to paddle a canoe.
Exactly. You just need to paddle faster.
But, the most vital exclusion criterion is debt.
Oh, this is huge. Let's talk about the debt trap.
If you are carrying high-interest consumer debt, credit card balances, or personal loans, allocating capital to a non-yielding asset like gold is just mathematically destructive.
It makes zero sense.
The guaranteed negative yield of a 20% credit card APR will aggressively outpace any theoretical inflation protection that gold might offer. For those individuals, paying down debt is the ultimate risk-free return.
Absolutely. So if you are listening right now and you have revolving credit card debt or, you don't even have a basic 3 to 6 month cash emergency fund, your marching orders are clear. Focus on the fundamentals.
Fix the leaky boat first.
Right. But assuming your financial house is in order, your debt is managed, and you are looking at a mature equity portfolio wondering how to insulate it from this stormy 2026 macro environment, well, we move to the next phase.
The allocation phase.
Right. If gold is the ballast, the immediate existential question is, how much weight do you actually put in the hull before you accidentally sink your own ship?
This is the science of portfolio allocation. And honestly, it is where the sources show absolute unanimity.
They all say the exact same thing.
They do. Across the ATI Beginner's Guide, the Money Analysis, and the Chase Institutional Framework, the universally recommended allocation for gold is between 5% and 10% of total investable assets.
It's so rare to see the financial industry agree so uniformly on a single metric. Let's dig into the math of why that specific 5 to 10% window is the holy grail of gold allocation. I mean, why not 2%? Or why not 25%?
Well, it comes down to optimizing the Sharpe ratio of the portfolio.
Right, the risk-adjusted return.
Essentially, yes. It's balancing the amount of return you get for every unit of risk you take. So if you allocate only 1 or 2% to gold, it is statistically insignificant.
It won't do anything.
Exactly. In a severe equity drawdown, a 2% allocation, even if gold surges in price, it simply will not generate enough counterweight to meaningfully mitigate your total portfolio loss.
So you just take on the complexity of managing a separate asset class without any of the actual mathematical benefits?
Exactly. But on the flip side, if you go too heavy, say 25 or 30%, you run headfirst into the yield problem we just discussed.
You drown your portfolio in dead weight.
Precisely. If a quarter of your wealth is locked in an asset that produces zero internal cash flow, you severely kneecap the portfolio's ability to compound over time.
So that 5 to 10% range is the mathematical sweet spot.
Yes. It is a large enough position to provide tangible shock absorption and reduce the overall volatility of the portfolio, but it is small enough that the lack of yield does not fundamentally derail your long-term growth trajectory.
Let's ground this in the real-world math that the sources provided. Imagine you've been diligently saving, and your total investment portfolio sits at $60,000.
Okay, a solid baseline.
Applying the rule, a 5 to 10% allocation translates to a target of between $3,000 and $6,000 in gold.
Right.
And that is your ceiling. The remaining $54,000 to $57,000 stays deployed in your equities, your fixed income, your real estate.
Which forces you to view gold strictly as a slice of the pie rather than the entire meal.
Exactly. And within that 5 to 10% band, the exact percentage you choose really depends entirely on your personal risk architecture, right?
Yes, it's highly personal. For instance, an aggressive younger investor who is heavily overweight in high beta tech equities, they might deliberately push toward the 8 or 10% mark.
Because their portfolio is already super volatile.
Right. They have a massive amount of volatility in their engine, so they require a heavier ballast to maintain equilibrium.
What about someone on the other end of the spectrum, though? Like a retiree who is actively living off their portfolio. You'd think they want maximum safety, so maybe they go even higher than 10%.
You would think so, but actually, the modeling suggests caution there.
Really? Why is that?
Well, while a retiree desperately needs volatility reduction, they are also fighting a multi-decade battle against inflation and longevity risk.
The risk of just simply outliving their money.
Exactly. They must generate yield to cover their monthly living expenses. Therefore, a retiree might actually skew toward the 5% lower bound.
Ah, I see.
They get the baseline insurance of the safe haven, but they preserve the maximum amount of capital for those dividend-paying equities and fixed income bonds to fund their daily lives.
That makes perfect sense. And the ATI guide makes a fantastic point for the absolute beginner here.
Yeah.
You do not have to hit 5% on day one.
No, absolutely not.
If reallocating thousands of dollars feels paralyzing, just start at 3%. Start at a level that doesn't trigger your fight or flight response every time you check your brokerage account.
Yes, because the objective is to pick a structural allocation that you can intellectually commit to for the next decade.
Not a number that makes you panic sell the moment the price of gold drops 2% on a Tuesday.
This raises an important question, though. We have established the theoretical framework, right? We know why it belongs in the portfolio, and we know exactly what percentage to target.
Right.
But the gold market is incredibly fragmented. Unlike buying a straightforward S&P 500 index fund, acquiring gold requires you to select a specific vehicle, and each vehicle carries fundamentally different risk profiles, cost structures, and mechanical traps.
Oh, this is the choose your fighter moment of the deep dive.
I love that. Yes, exactly.
The sources categorize this into 3 primary paths for retail investors. Let's start with the one that captures the imagination the most. Path 1, physical gold.
The classic approach.
We are talking sovereign minted coins, bullion, physical bars. There is a deeply ingrained, almost primitive, psychological appeal to holding a dense, heavy asset that is 99.99% pure gold in your hands.
The psychological comfort is very real. But from a strict risk management perspective, holding physical metal provides one supreme structural advantage: the absolute elimination of counterparty risk.
Okay, let's define counterparty risk for everyone, because this is where the physical advocates make their strongest stand.
Counterparty risk is essentially the probability that the other party in an investment, contract, or transaction will default on their contractual obligation.
Right, like if you own a corporate bond, you rely on the corporation remaining solvent to actually pay you back.
Exactly. If you hold cash in bank, you rely on the bank's liquidity and the FDIC insurance apparatus. But if you hold a physically settled gold coin in your hand, its existence and intrinsic value are not dependent on the survival, honesty, or solvency of any financial institution or government body.
It's just a rock in your hand.
Right. In a true systemic collapse, it is an asset with 0 liabilities attached to it.
Now, I understand the appeal of that. I really do. But I'm going to push back hard here, because I think the sources reveal that retail investors dramatically underestimate the cost of this purity.
They absolutely do.
You aren't eliminating risk. You are just trading institutional counterparty risk for physical logistical risk. So let's talk about the math of acquiring this metal, starting with premiums.
The premium is where the reality of physical gold violently collides with the retail investor's expectations.
It's a harsh wake-up call.
Very harsh. Because the spot price you see on the news, that $5,000 figure, is the wholesale price for large institutional delivery contracts.
It's big boys.
Exactly. You, as a retail investor, cannot buy an ounce of gold for spot. You just can't. You have to purchase it through a dealer who acts as a middleman.
And they aren't working for free.
No. That dealer has to cover the cost of fabricating the coin, their wholesale markups, shipping, vaulting, and, of course, their own profit margin.
So they charge a premium over spot. The ATI guide uses a simplified mathematical example to illustrate this, which I think is great. Let's say the spot price of gold is exactly $2,000 an ounce.
Okay.
A standard dealer premium for a widely recognized 1-ounce coin, like an American Gold Eagle, is typically between 5% and 10%. So let's say it's 7%.
Right.
You aren't paying $2,000. You're paying $2,140 out of pocket.
And this is the mechanical trap right here. That $140 premium is immediately vaporized the moment you complete the transaction.
Poof, gone.
Gone. If you experience buyer's remorse and attempt to sell that exact same coin back to the dealer 5 minutes later, they are not going to refund your premium.
No way.
In most market conditions, they will offer you a price at, or sometimes slightly below, the current spot price.
So you are instantly in the red. You have suffered a 7% loss on your capital on day 1, minute 1.
It's brutal math.
The spot price of gold now has to appreciate by 7% just for you to break even on your initial investment. That completely destroys the idea of physical gold as a short-term trade.
It absolutely mandates a multi-year hold time. You have to wait for the macro cycle to lift the spot price over your premium.
But the friction doesn't even stop at the premium, does it?
Not at all. You correctly pointed out the shift to physical risk earlier. If you have $50,000 worth of gold, you cannot just leave it in a desk drawer.
I mean, you could, but you shouldn't.
Right, you shouldn't. You are now personally responsible for institutional-grade security.
Which means buying a heavy, fireproof, high-security home safe. And that is a capital expense.
Or you rent a safety deposit box at a bank.
Which is deeply ironic if your whole goal was to avoid the banking system in the first place.
It is very ironic. And that introduces an ongoing annual storage fee, by the way.
Right. And then there is insurance.
Oh, the insurance. Most standard homeowners insurance policies have very strict, incredibly low sublimits for precious metals and jewelry. They often cap out at $1,000 or $2,000 total.
Wow, that wouldn't even cover half a coin at these prices.
Exactly. To properly insure a physical gold allocation, you generally have to purchase a separate, scheduled personal property rider.
So let's add this all up. You take a 7% hit on the premium. You spend $1,000 on a safe. You pay an annual percentage of the value for the insurance rider.
It adds up fast.
Every single one of those expenses is a direct drag on your total return. When you factor in the fact that the asset produces zero yield to offset those costs, physical gold suddenly looks like a logistical nightmare for a standard 5% portfolio allocation.
Which is exactly why the vast majority of institutional capital and really sophisticated retail money utilizes Path 2, gold exchange-traded funds or ETFs.
The beginner's best friend.
Truly, this structure strips away the physical friction while maintaining the direct price exposure.
Right, because an ETF trades on standard stock exchanges during normal market hours. You open your brokerage app, search for the ticker symbol, and just click buy. It is infinitely easier.
It takes 10 seconds.
But how does it actually work under the hood? I mean, if I buy a share of a gold ETF, what do I actually own?
In a physically backed gold ETF, which is what the sources highly recommend for this specific use case, the fund manager purchases massive 400-ounce institutional gold bars.
The big movie-style bricks.
Exactly. And they store them in highly secure, audited vaults in places like London or New York. They then issue shares that represent a fractional ownership interest in that underlying pool of metal.
So you get the exact price action of the $5,000 spot price without ever having to negotiate with a coin dealer or hire a security guard.
The advantages are profound. I mean, the liquidity is instantaneous. You can liquidate a massive position in milliseconds with razor-thin bid-ask spreads.
Try doing that with a safe full of coins.
Exactly. Storage and insurance are handled at an institutional scale, which is vastly cheaper than what you could achieve individually.
But I'm going to challenge the perfection of this just a bit, because earlier we talked about counterparty risk.
Fair point.
If I own a gold ETF, I don't hold the gold. I just hold a digital ledger entry at my broker that says I own shares in a fund, which is managed by a Wall Street firm, which claims to have gold in a vault managed by a third-party custodian bank.
It's a chain.
That is a massive chain of counterparties.
It is a valid structural critique, absolutely. You are absolutely reintroducing counterparty risk. You are trusting the regulatory apparatus to ensure the vault isn't empty and that the custodian isn't rehypothecating or lending out the underlying metal.
So for the hardcore prepper, it's a no-go.
Right. For the hardcore safe haven purist preparing for a catastrophic collapse of the financial grid, an ETF is useless. But for the investor whose goal is simply to hedge against inflation and equity volatility within a functioning financial system, the ETF structure is vastly superior.
Okay, that makes sense.
However, it carries its own specific mathematical drag, the expense ratio.
Right, Wall Street doesn't vault gold for free. The ATI guide notes that expense ratios for major gold ETFs typically run between 0.25% and 0.50% annually. Let's break down the mechanics of how that fee actually impacts a zero-yield asset.
This is a crucial concept. Let's use the source materials example. Assume you allocate $10,000 to a gold ETF with a 0.40% expense ratio.
Okay, $40 a year.
Now, if you invest $10,000 in a dividend-paying equity ETF with that exact same fee, the 3% dividend yield easily covers the 0.40% fee, and you still generate positive cash flow.
But gold has no yield.
Exactly. So how does the fund manager get paid?
They sell the gold.
Yes. They mechanically sell small increments of the underlying gold in the vault to cover the storage and management costs. So, if the spot price of gold remains completely flat for an entire year, it starts at $5,000 and ends at $5,000, your $10,000 investment will not remain flat.
It bleeds.
It will slowly bleed down to roughly $9,960. You are guaranteed to lose value in a flat market. This makes hunting for the absolute lowest cost ETF critical.
That is such a vital distinction. Okay, so we have physical metal with its high upfront premiums and ETFs with their slow compounding fee drag.
Yeah.
That brings us to path 3, which the sources highlight as a completely different paradigm: gold mining stocks and funds.
It is paramount that listeners understand the distinction here. When you buy a mining stock, you are not buying a commodity.
You're buying a company.
You are buying an operating business. You are buying human management, heavy machinery, diesel fuel costs, geological risk, and geopolitical risk.
The fundamental appeal, as I understand it, is leverage. The miners offer a leverage play on the price of gold. Can you break down the math of how operational leverage actually works?
Let's construct a simplified model. Assume a mining company has an all-in sustaining cost, or AIC, of $4,000 to extract 1 ounce of gold from the earth.
Okay, that covers everything: labor, fuel, equipment.
Right, so if the spot price of gold is $4,100, their profit margin is a very tight $100 per ounce.
Just $100 profit.
Now, imagine a macro shock occurs and the spot price of gold jumps 20%. So it goes roughly from 4,100 to just under 5,000.
Okay.
The underlying commodity only moved 20%. But look at the miner's profit margin. Their cost to mine is still fixed at $4,000, but they are now selling at $5,000.
Oh, wow.
Their profit per ounce just exploded from $100 to $1,000.
That's a 900% increase in profit margin off a mere 20% move in the commodity.
Exactly. That is operational leverage. The equity of the mining company will theoretically violently re-rate upward to reflect that massive influx of cash flow, drastically outperforming the spot price of gold.
That sounds incredible, but leverage is a double-edged sword. It cuts both ways.
Oh, deeply.
The Money article emphasizes the massive company-specific risks involved here. I mean, you could be dead right about the macro environment. Gold hits all-time highs, inflation is soaring. But if the specific mining company you invested in experiences a catastrophic labor strike,
Or a government decides to nationalize their primary mine.
right, or their geological surveys were just wrong and the ore grade is terrible, that stock will plummet regardless of what the yellow metal is doing on the global market.
Which fundamentally defeats the purpose of the initial allocation. Remember the mission. We are looking for a portfolio ballast. We want an asset to reduce volatility and provide uncorrelated stability.
And miners just add more chaos.
Mining stocks introduce hypervolatility and massive equity correlation back into the portfolio. They are an aggressive growth play disguised as a precious metals play. For the beginner seeking stabilization, miners should be completely avoided.
Now, I want to pause here for a second because the Chase institutional guidance briefly touches on some highly advanced instruments, options contracts and futures contracts.
Yes, the derivatives market.
And I want to push back on the idea of completely ignoring them. I mean, if I have a $500,000 portfolio and I'm deeply worried about a short-term currency shock over the next 3 months, isn't buying a gold futures contract vastly more capital efficient?
In theory, yes.
Instead of tying up $25,000 in physical metal or an ETF, I can use a fraction of that capital as margin to control a massive amount of gold exposure. So why should we completely dismiss the tools that the professionals actually use?
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
Your argument for capital efficiency is theoretically sound. If you are a proprietary trading desk managing a delta-neutral book.
Fair enough.
But for a retail investor allocating 5% for long-term ballast, futures are lethal. First, futures contracts utilize massive leverage. A small adverse move in the spot price can trigger a margin call that wipes out your entire account.
You can lose more than you put in.
Exactly. Second, futures contracts expire. They are not buy and hold assets. You have to constantly roll the contracts forward before expiration.
And that introduces roll yield, right?
Yes. In normal market conditions, a state called contango, the future price of gold is higher than the spot price due to storage costs and interest rates.
Okay.
So when you roll your contract, you are mechanically selling low and buying high every single month. That roll yield will structurally chew through your capital over a long holding period.
Wow, that sounds exhausting to manage.
It is, and options suffer from time decay. known as theta, where the contract literally loses value every single day it approaches expiration.
The clock is ticking against you.
Exactly. These are short-term directional trading vehicles, not long-term structural hedges. If you want a 5% ballast, just keep it simple. Use an ETF.
Good. The point is well taken. Simplicity over theoretical efficiency. So let's transition to the execution phase.
The mechanics of actually buying.
Right. You've accepted the mindset shift. You've settled on a 5% target allocation. You've selected a low-cost ETF to avoid the logistical nightmares of physical storage.
Check and check.
Now you have to actually pull the trigger and buy it. And this is where the psychological paralysis hits.
Every time.
We are at $5,000 an ounce. The market feels toppy. Every beginner sits there staring at the screen wondering, do I buy today? Do I wait for a pullback? What if I drop $3,000 in right now and it crashes tomorrow?
Market timing is the ultimate destroyer of retail wealth. The anxiety of trying to optimize the perfect entry point often leads to total paralysis, or worse, buying in a panic at the absolute peak of a rally.
Here's where it gets really interesting, though. The sources provide a deeply mechanical, mathematically proven framework to outsmart your own human psychology. Dollar cost averaging, or DCA.
The holy grail of retail execution.
But I want to really dig into why DCA is so critical, specifically for a highly volatile commodity like gold, as opposed to just buying a lump sum.
Dollar cost averaging is the systematic deployment of capital at regular intervals, regardless of the asset's price. Let's return to our $60,000 portfolio example where you need to build a $3,000 gold position.
Okay, so I need to spend $3,000.
Instead of executing a single $3,000 market order on a random Tuesday, you program your brokerage to automatically purchase $250 worth of your chosen gold ETF on the first of every month for 12 months.
So the brilliance here is how the math passively exploits the volatility of the asset class.
Precisely. Let's model the price action over that year. In month 3, perhaps inflation data cools, the market panics, and the price of gold drops 15%.
Your stomach drops.
Human psychology screams at you to stop buying, but the automated DCA mechanism executes anyway. Because the price is lower, your fixed $250 mathematically acquires more fractional shares of the ETF.
You are automatically bargain hunting without having to make a conscious decision to be brave.
And conversely, in month 8, maybe geopolitical tensions spike and gold surges to new all-time highs.
FOMO kicks in.
Right. Your $250 purchase executes, but because the price is inflated, you automatically buy fewer shares.
That is so smart.
You are structurally restricting your purchases at the top of the market and accelerating your share accumulation at the bottom. Over the course of the 12 months, this smooths out your average cost basis, completely eliminating the catastrophic risk of dumping all your capital in on the worst possible day of the year.
It effectively removes the emotional burden of forecasting. You just build a machine, turn it on, and walk away.
It's beautiful in its simplicity.
Now, if someone is dead set on the physical route, despite our warnings about premiums and safes, they can still use DCA by buying a coin every quarter, right?
Yes, you can manually DCA physical metal.
But the ATI guide provides a very strict, non-negotiable checklist for executing a physical purchase. We need to go over that.
The primary risk in the physical market is outright fraud or gross overpayment.
Buying fake gold or getting ripped off.
Exactly. So the first rule is dealer verification. Do not buy precious metals from social media advertisements, high-pressure late-night television commercials, or unvetted online marketplaces.
No guy selling coins out of his trunk.
Absolutely not. The Chase guidance explicitly recommends cross-referencing any dealer with the United States Mint's authorized purchasers list.
Second is purity verification. For strict investment-grade allocation, you are looking for 99.9% or 99.99% purity.
Yes!
Which encompasses sovereign bullion like the Canadian Maple Leafs, the American Gold Buffalo, or standard Swiss bars, no weird collectible medallions.
And the final step is calculating the true aggregate entry cost before executing. You cannot just look at the spot price.
We talked about this, the hidden cost.
You must calculate the spot price, add the dealer's percentage premium, add the insured shipping costs, and immediately factor in the prorated cost of the insurance rider for your home safe.
Only then do you understand your actual cost basis and how far the market needs to move for you to simply break even.
It requires a lot of math up front.
Okay, so the execution is done. Your 12-month DCA has concluded. You hold your 5% allocation.
Mission accomplished.
Right. The natural instinct is to dust off your hands, close the app, and ignore it for the next 20 years. But the sources are adamant that gold is not a set-it-and-forget-it asset. It requires ongoing mechanical maintenance.
It requires a strict adherence to a 12-month rebalancing schedule. Rebalancing is the most mathematically powerful yet psychologically counterintuitive concept in portfolio management.
Let's walk through the mechanics of portfolio drift, because if you don't understand drift, rebalancing just feels like you're randomly selling things for no reason.
Let's use the exact mathematical model from the source material, example A. You establish your $60,000 portfolio, and you execute a precise 6% allocation to gold, which equals $3,600.
Yeah, we're locked in at 6%.
Now, we advance the timeline by 1 year. The macroeconomic environment has been incredibly turbulent. The S&P 500 traded flat, maybe down 1%. But gold performed its function beautifully as a safe haven. It surged 20%.
Wow, okay, so your $3,600 gold position has grown to roughly $4,320.
Exactly. But because the rest of your portfolio didn't grow, the total pie is relatively stagnant, while the gold slice just got much larger.
Oh, I see.
When you recalculate your percentages, gold no longer represents 6% of your portfolio. Due to its price appreciation, it has drifted up to perhaps 8 or 9% of your total assets.
And if you let that run over a 5-year bull market in gold while equities stagnate, you might wake up and find that gold now constitutes 15% of your portfolio.
Which means your portfolio architecture is fundamentally broken.
Because it's too top-heavy with ballast again.
Remember, you initially decided on a 6% allocation because that specific number aligned with your long-term risk tolerance and your need for equity yield.
Right.
If you allow the position to organically drift to 15%, you are suddenly holding a massive, non-yielding anchor that will severely drag down your compounding growth when the market cycle inevitably turns back to equities. You are exposed to a risk profile you never explicitly consented to.
So rebalancing is the mechanical act of fixing the drift. But to fix it, you have to do something that violates every human instinct.
It hurts to do it.
You look at your portfolio, you see that gold is your absolute best performing asset. It's the only thing making you money, and the rebalancing rule says you have to sell it.
Yes, you must intentionally trim your winners.
It feels so wrong.
It does. But to reset the portfolio back to the 6% target, you calculate the dollar amount over your target, and you sell those shares of the gold ETF. You harvest the profit.
And then what?
And then you take that cash and you deploy it into the assets that performed terribly over the last year, in this case, your equity funds.
It is a mechanical system that forcibly makes you buy low and sell high.
Precisely. Human psychology wants to chase momentum. It wants to buy more of whatever just went up and sell whatever just went down in a panic.
Rebalancing removes the emotion.
It structurally harvests volatility, systematically taking chips off the table from overvalued assets and reallocating them to undervalued assets, all while keeping your holistic risk exposure perfectly flat.
It ensures your ballast remains a ballast and doesn't accidentally become the entire hull of the ship.
Exactly.
This deep dive into the mechanics of drift and rebalancing is the perfect bridge to our final segment, because misunderstanding these operational realities is what destroys retail capital. We want to synthesize the money and chase analyses into a definitive list of the classic traps, misconceptions, and reality checks that snare first-time gold investors. We want to illuminate the potholes.
The most pervasive and dangerous trap is the psychological anchor of recency bias, which manifests as the absolute belief that gold always goes up.
It is incredibly difficult to fight that narrative when the headline sitting in front of you screams $5,000 an ounce. Your brain just assumes a parabolic trajectory is the natural state of the asset.
But historical data provides a brutally sobering reality check. Gold is highly cyclical and is prone to massive, agonizingly long drawdowns.
The lost decades we talked about.
Right. The ATI guide provides example B to illustrate the math of a cycle shift. Let's say an investor succumbs to FOMO and buys physical gold when the spot price is $2,000. They pay a 7% premium, meaning their true cost basis is $2,140.
And then the macro environment changes. Central banks successfully tame inflation, interest rates stabilize, and institutional capital rotates out of defensive assets and back into high-growth tech equities.
The safe haven premium evaporates. The spot price of gold drops from $2,000 to $1,800 and plateaus there for 4 years. The investor's physical coin is now worth $1,800. They have suffered a massive capital loss, not just from the spot price decline, but compounded by the initial premium they paid.
They are down over $340 per ounce.
And because there is no yield or dividend to cushion the blow, they simply have to sit in the red for years, hoping the macro cycle eventually turns back in their favor.
It reinforces the reality. It is a risk mitigation tool, not a risk-free guarantee. Misconception number 2 is the silent erosion of returns, specifically regarding taxes.
The hidden killer.
We've hammered on premiums and ETF expense ratios, but the tax code is where beginners get completely blindsided.
This is a critical legal reality. In many jurisdictions, including the United States, physical gold and silver are not taxed as standard financial assets.
Yes, they aren't.
No. They are legally classified as collectibles, governed by the exact same tax codes that apply to rare art, antiques, or vintage wine.
Which means they do not qualify for the standard preferential long-term capital gains tax rates that apply to stocks and bonds.
Exactly. If you hold an equity ETF for over a year and sell it for a profit, your long-term capital gains rate might be 15 or 20%. But the federal tax rate on collectibles in the U.S. can be as high as 28%.
28%, wow.
Yes. If you execute a massive physical gold trade and assume you'll be taxed at equity rates, you will face a devastating surprise when you file your returns. Furthermore, the tax treatment of gold ETFs can be highly complex. Some are structured as grantor trusts, where you are taxed on the underlying metal as a collectible, while others use completely different structures.
This is why every single source we reviewed includes the same massive disclaimer. Consult a qualified tax professional before establishing a significant precious metals position. The tax drag can completely wipe out the inflation protection you were trying to achieve.
It's just math.
Moving on, misconception number 3 is what the behavioral finance analysts call the single dramatic move.
This is the capitulation trade. It is the investor who has ignored gold for a decade, watches the news on a particularly terrifying week in 2026, feels an overwhelming sense of systemic panic, and unilaterally decides to liquidate 40% of their 401k and dump it into gold at market open on Monday.
It is the ultimate violation of the DCA protocol.
The absolute opposite of what we just discussed.
And mathematically, when retail panic is at its absolute highest, that is almost universally the exact peak of the local market cycle. You are providing exit liquidity for the institutions who bought the bottom.
You guarantee you are acquiring the asset at maximum valuation right before the geopolitical tension eases and the price violently reverts to the mean. It is financial self-sabotage driven purely by the amygdala.
Which perfectly tees up the final and perhaps most philosophical misconception. The belief among hardcore gold bugs that gold is the only hedge that matters.
If we connect this to the bigger picture and look at the macro architecture of wealth preservation, true resilience is derived from structural diversification across multiple uncorrelated asset classes.
Gold is a single wrench in a massive toolbox. It cannot perform every function.
A truly bulletproof portfolio relies on a complex web of assets. You need global equities to capture corporate innovation and compound real wealth.
Right.
You need high-quality fixed income to provide predictable cash flow and dampen equity volatility. You might utilize real estate for tax-advantaged cash flow and physical utility. And you allocate a surgical 5% to gold strictly for that non-yielding, zero counterparty shock absorption.
Demanding that gold serve as your growth engine, your income generator, and your sole inflation hedge is mathematically impossible. It will fail.
It just wasn't designed to do all of that.
Okay. We have covered a massive amount of ground today. If you're sitting on the couch right now, looking at your brokerage app, let's distill everything we've extracted from Chase, Money, and ATI into a definitive, step-by-step operational plan.
A clear roadmap.
Step 1. Establish your percentage. We mathematically proved why 5 to 7% is the optimal starting target to gain the portfolio stabilization benefits without suffering the yield drag.
Very important.
Step 2. Select your mechanism. If you demand physical possession and are willing to eat the premiums and manage the logistics, use the U.S. Mint's authorized list to avoid fraud. But if you want institutional efficiency, liquidity, and simplicity, bypass the physical friction and identify a physically backed gold ETF with the lowest possible expense ratio.
That's the route most will take.
Step 3. Automate the execution. Do not try to time the $5,000 top. Implement a dollar-cost averaging program, dividing your target capital into 12 equal monthly tranches to systematically smooth out the volatility.
Set it and let it run.
And finally, step 4. Set a calendar reminder right now for 12 months in the future to review your portfolio drift and brutally execute a rebalance if the asset has outgrown its target allocation.
It is a systematic, emotionless approach to a highly emotional asset class.
And before we sign off, I want to leave you with one final, slightly more philosophical thought based on everything we've analyzed today.
We operate in a 2026 financial ecosystem dominated by artificial intelligence, high-frequency algorithms executing trades in nanoseconds, decentralized finance protocols, and complex derivative structures. The sheer technological complexity of modern capital markets is staggering.
It's almost incomprehensible sometimes.
Yet, when the systemic structure shakes, when inflation spikes or sovereign debt looks fragile, the most sophisticated institutions on the planet, the sovereign wealth funds and central banks, bypass the digital complexity.
They go right back to basics.
They instinctively revert to accumulating a heavy, dense, chemically inert yellow metal that has been sitting in the Earth's crust for 4 billion years. As you build and manage your own portfolio, it begs a fascinating question. How much of global finance is truly driven by complex, rational mathematics, and how much is ultimately anchored by ancient, fundamental human psychology?
It's a brilliant reminder that underneath the flashing tickers and the algorithmic models, markets are just aggregations of human fear and human greed, looking for something solid to hold on to in the dark. Thank you for joining us on this deep dive. Take that systematic plan, run your own numbers, and we will see you on the next one.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.